you've got your accepted application, everything's kind of good to go. And then there's that time period where you're not ready to buy the house yet, but as far as you know, the bank doesn't need anything else from you or the lender doesn't need anything else from you. What's happening during that time and what can go wrong? You got your pre-approval, you're all set to go, but then there's something about the house itself that makes it so that the lender doesn't want to lend on it.
There's a lot that could potentially go wrong. A lot of them might be far-fetched, but there are things that are outside of your control that can go wrong. So to this point in time, like we've talked about, you get pre-approved, you're searching for your home, you find your home, you put under agreement, and you start the loan process. Now, off the bat, we're going to give you those updated docs we need. The file is going to go down to processing, where they're going to issue you some initial disclosures. You're going to e-sign all of those, wet sign what you need to. The file goes to underwriting, they underwrite it, and we can issue an approval to a client that you are financially approved to buy this home, but it might be contingent on things. It could be contingent on an appraisal coming back. Now, the appraisal isn't to be confused with your inspection. You might order an inspection during the real estate transaction to comment on the condition of the home, but the lender is going to order an appraisal in most all circumstances to comment on the value of the home as compared to other homes that were sold in recent history in that area. And that has to come back, and you're hoping to see it come back in most all circumstances at the value or higher that you are under a contract to purchase the home. You're also hoping to see it come back, as we call it in the mortgage world, as is. And as is means this home is worth this much money as it is. It can sometimes come back subject to the completion of X, Y, or Z. And, examples of what that might be is no railing installed on the front steps that were 5 steps up to the front door. That needs to be there for it to be up to code and safe and for the appraisal to sign off on. Now, that's a pretty minor example that typically can be rectified, but there are things that could come back on appraisal that, even though you're financially approved, do make the deal not work out. It could be something that the seller just doesn't want to fix and doesn't want to deal with, and all of a sudden there's an impasse in negotiations. It could be that the value of the house came in so low that the lender can no longer lend the same amount of money they had initially planned to lend to you, and that could potentially mess up financing. So there's a lot of things that could change, things out of your control. If we're not to scare people, but if there's layoffs at your company, and you find yourself out of work, it's out of your control. All of a sudden, the loan doesn't work. Now, it does have to do with your financing, but again, things out of our control. So, there comes a point in time when you're financially approved, maybe even the appraisal back, and that's not one of the variables. But you find yourself in this period of time where you're not really doing anything. And I call that thumb twiddling time, where you just kind of like, DMV style, hurry up and wait. There's nothing to do anymore. And it can actually be the most anxiety provoking point of the transaction for a client, because you're busy, you're doing things, you're in constant communication with everyone in the first week or so. And all of a sudden you're approved and closing's not for 3 weeks, and then it's radio silent and your imagination starts to wander. Again, that's where communication can come in. You're hoping to work with the lender who, even when there's nothing to report, might be checking in with you. I weekly try and make sure there's one touch with every client to make sure that they understand where they stand. Even if that update is update, no update, everything's the same. That silent space can be very scary. But during that period of time, there probably is still things going on with the mortgage. It's just on the back end, processors and everyone doing the nuts and bolts. As we approach your closing date, typically within 10 days of close, the lender is going to be reaching out to your employers to get verifications of employment to make sure you are still employed. Certain lenders might be ordering tax transcripts to show that what you provided on your W-2s, your tax returns actually lines up with what the IRS gives back to us as your filed tax return. So there is a lot of back office administrative stuff that theoretically could go wrong, but very rarely should actually debunk a mortgage process. But can it cause hiccups? Sure. That's why, again, typically you're working with good processing and closing teams that get these things done in good order.
Talk a little bit about the appraisal process. What is involved in that? What happens there?
Yeah, so upon accepted offer, once you have the official application, if you have a contract in hand in Massachusetts, that would be an offer to purchase. In New Hampshire, that might be the official P&S, as they only sign one contract there. State to state, it might vary. But once you have an official contract in hand, you can create the appraisal order. And like I mentioned, it's not the inspection that's purely there to educate the buyer on what the condition of the home is. It's really more for the lender to figure out what's the value of the house they're lending on per this one appraiser's, I hesitate to say opinion, because it should be more than that, but you might say one appraiser's opinion. And what they do to figure out the values, again, like I mentioned before, they look at recent comparable homes, similar homes that were sold in a pretty close area over a recent period of time, and determine, based on what these homes sold for, what do we think this home is worth? And that process, you order the appraisal. The lender themselves, not the loan officer. I'm not allowed to speak to appraisers. Let's be very clear about that. There's no interaction to be had between the lender and appraiser. But the loan company, will order the appraisal, and it might be through an appraisal management company. It could be direct to an appraiser themselves, the company themselves. Again, not me, but someone from the appraisal desk, or however that company does it, to order them. And they're going to reach out to the listing agent, and they're going to schedule a time to go to the house to walk through it, take some photos. They'll leave. They're going to collect some information on the comparables, and they're going to drop what's called an appraisal report and provide that back to the lender. On that appraisal report, it's going to tell them if there's work that needs to be done to the house. That's the as is, as opposed to subject to portion that I was talking about. And they're going to assign a value to it. That value is what the lender uses to assess the true value of this home. Now, if the value comes back high, the lender is still going to use the lower value of the sales price. If the value of the appraisal comes back low, they're no longer going to use the sales price for all their calculations. They're going to use the low appraisal. It's the lower of the appraisal and the sales price that the lender is going to use for the purposes of their loan calculations. So from start to finish, you order the appraisal. The appraiser schedules it, they come out, they make the appraisal report, they give it back to the lender. That is now the value that's used for the home. In the circumstances where an appraiser comes back and the client does not believe that appraisal to be accurate, you can contest the appraisals. To do that, typically you need to come up with your own comparable homes that are sold in the area that you believe actually do show that that home is worth what you think it's worth, as opposed to what the appraiser is worth. You'll submit it through the formal process to that appraiser, and the appraiser will come back and see if they see reason in what you've submitted, and see if they choose to change the value. But at the end of the day, it's still up to the appraiser to review what you submitted and decide if it's actually reasonable that they might have misassessed the value of the home.
So then what happens if, let's say that you're buying a house for $200,000 and then the appraiser comes back and says, oh, sorry, it's only worth 180. And you were only going to put down, you had $10,000 to put down on the house for your down payment. Then what would happen from the bank's perspective?
Yeah. And so you hit the nail on the head with some of the factors that are important there, because a low appraisal at face value in real life implications might imply that you're not actually purchasing this home for what it's worth. You might be purchasing it for higher. Now, that's a whole different conversation, because, with the details of the comps they use, if it was 4 months ago as opposed to 1 month ago, values could change in that time. Maybe you feel that that's not true, but you do have the value. You still want to go through with the transaction if you can. From the lender's perspective, it's really about numbers. So if it was a $200,000 home and the appraisal came at $180,000, but you were putting 50% down, it might not be an issue for you. But if you're buying a $200,000 home, you're putting $10,000 down, 5%, as you mentioned, Chris, and it comes in $20,000 low, well, that's an issue, because the lender is probably not going to lend you $190,000 based off a value of $180,000. That's them giving you more than 100% of the value of the house. And the way the math works, if we're going to try and be most educational about it, is that a lender to a first-time home buyer in most all circumstances is not going to lend more than 97% the value of the house. The value being determined by the sales price or the appraised value, whichever one is lower. If you're not a first-time home buyer, it might be the case where you put 5% down, so they're not going to lend you more than 95% of the value of the house, as determined, the value being determined by the sales price or the appraised value. So let's use a 5% example. You bought the home for $200,000, or you're buying it for $200,000. You're putting 5% down. That should be a $10,000 down payment. So the lower amount's $190, but the value comes back at $180. Now the lender is only going to give you up to 95% of the $180,000 value, because that's the lower of the two, and now what the lender is going to calculate everything off of. thankfully I have my calculator in front of me, and 95% of 180 is 171. That's the most the lender is going to give you now. Your original loan amount was supposed to be 190, and you agreed to purchase the house for 200. So you can't just say, well, we're not going to buy it for 200 anymore. And you have to go through with the deal, talking to the seller. You can't just tell the seller they have to do that now. So the idea would be, if you're going to deal with this, if you're going to be the one to make up the difference and still make this deal work financially, there is now a difference of about $19,000 that you'd have to be making up. Because again, the original amount you're asking for is 190. You're going to purchase it for 200, but now the value is 180. The most the lender is going to give you is 171. So the simple math on that would be, you're buying it for 200, but the biggest loan you can get is 171. So really, you need the $29,000 down payment now to make the financing work. Again, in the real world here, if you have the right to, still in the contract, which is more of a, that is more of an attorney and realtor question maybe, but it's still the right to, you can potentially negotiate. So if it came in that low and you have the right to negotiate still, you could see if you can bring down the value of the house and quote unquote split the difference with the seller somehow. But truthfully, if we're trying to keep it black and white in the finance world, in the mortgage world, if an appraisal comes in low, the fear would be that the bank's not going to be able to give you as much money as you initially thought in the loan amount. And that could mean that you can no longer pay the full sales price that you had first intended.
Yeah, exactly. So Todd, can you talk a little bit about underwriting? What is underwriting and what happens there?
So yeah, when we're going through the mortgage process, as we mentioned, you get the loan application, and then the file goes down to your processors who are going to disclose the loan. Those are all the initial disclosures, the things that the client needs to sign so that the back office and the mortgage company can do what they need to, or the things they need to from the various agencies that are involved. It also gives you information on the loan that you agreed to. It gives you your loan estimate, which is going to show you the estimated rate, the annual percent, the APR, estimated payments, estimated closing costs, all these things. Once it's through processing, it goes to underwriting. Now, underwriting, I think we've all heard the term underwriter and underwriting before, but it might be a little ambiguous as to what actually happens there. When you get pre-approved with the loan officer, we're not underwriting the file. We're pretty well aware of underwriting guidelines. We're doing, again, why you want to work with somebody who's kind of experienced knows what they're doing. We're basically we're pre-approving a loan. we're giving an initial scrubbing of like the file and your finance and getting your documents to assess what you're going to be able to buy. But your file is not going to get underwritten until you actually get the accepted offer and official application. And that's where your file goes to an official underwriter who is licensed. They're the one who actually makes the credit decision. A lender does not make a loan officer does not make a credit decision. I don't tell people if they do or don't get a mortgage or can or can't get a mortgage. I cut a pre-approval. I help you through the loan search process. And then eventually you're going to make it to the underwriter who does make the credit decision. So they will, per the policy of that individual lender and in accordance to the guidelines they follow, Fannie Mae and Freddie Mac, those would be the ones, they underwrite the file to issue the credit approval or denial or counter offer if it's a refinance in some circumstances, but they make a credit decision. They tell you if you've been approved. And most frequently, that initial approval, the initial loan approval is going to be conditional on certain things. So it'll be your loan has been approved conditional upon you providing an additional pay stub, verification of employment from your employer. It's going to have certain terms to it, but they're typically pretty routine. And then you work with your loan officer and your team to make sure that you complete any of those conditions that you are responsible for.